Hello, are you here for some help?
I don't think you. I'm good. I'm just looking around. I just bought the place. So, is that what you guys do the loans? I'm not shooting that again. That. Welcome back to the channel that simplifies the stock market. So in this video, I'm going to give you the walkthrough on regional management. I bought some shares in regional management a couple weeks ago for an average price of around $44 per share. Right now it's priced at around $47 per share, giving me an unrealized gain so far of a little over 5%, but who cares? That's a short term. And I don't plan on selling my shares anytime soon. Hopefully. So let's just get into it and look at the business. We'll throw up our checklist and look at regional management to see if it's a good business that you can buy for a good price, because that's how you're going to make money in the stock market. First up, let's look at what the company does and how it makes its money so we can understand the business. Okay, so I pulled up regional management's 10K report so we can look at the company's business overview and just get a feel for what the business does and what they sell, so on and so forth. So in this first sentence, we can see that it says, we are a diversified consumer finance company that provides installment loan products primarily to customers with limited access to consumer credit from banks, thrifts, credit card companies, and other lenders. So basically, these customers that have limited access to these different products are ones that don't have the greatest credit. So they likely won't have credit scores of above 700. This is who regional management is catering to or servicing. And then you could just read through this just to get a feel for the actual business, just a quick overview in its first paragraph. Now, as far as their products, you can see what kind of loans they offer: the small loans, large loans, retail loans, and then optional payment, collateral protection, insurance products. So if you want to, you can pause the video just so you can read each of these descriptions. And then I already touched on this a little bit, but in the industry, customers, and purpose section, you can see this sentence here. It says, we operate in a consumer finance industry in which customers are generally described as super prime, most creditworthy, prime, near prime, non-prime, subprime, and deep subprime, which is the least creditworthy. Our customers typically have less than perfect credit profiles, and for that reason are generally considered subprime, non-prime, and near prime consumers. And from here, I want to see what kind of protections the company had in place for lending out money to those that don't have the greatest credit. And that's the next thing that I searched for when I was looking at the report and reading through it. Now, when I scroll down a little bit further, you can see, okay, here are some of the protections. In this paragraph right here, it says the average annual percentage rate, the APR, of our small loans originated in 2020 was 42.1%, which is extremely high, but it's just part of the things that you have to do when you service or you issue loans to those that don't have the greatest credit. Because there's a chance that from regional management standpoint, the money that they lend out, they won't get back. So they have to charge more in interest on their loans. And then it goes on to say that their large loans, which are reserved for higher credit quality customers who meet more stringent underwriting requirements, had an average APR of around 30.1%. And this is just one of the things that I looked at and I checked off the list as far as, okay, how do they protect themselves from lending out money to lower credit customers? And this is what they do. They charge more interest for their loans. But I wanted to get a little bit more. That wasn't enough to satisfy me. And then I read on to see how they actually secure their loans. And they secure their loans by requiring the borrower to put up some collateral, whether it's their house, car, etc., which is lightly touched on in this sentence right here. Now, regional management, of course, would prefer that the customer pays back the loan plus interest. They don't want to go through the hassle of repossessing the car and then selling the car. All that has costs associated with it. But it does give me, as an investor, some level of comfortability that they're not just issuing out money or issuing out these loans and they don't have them securitized. And this section goes on to talk about the insurance that they offer. And in this first sentence, it says, we also offer our customers various optional payment and collateral protection insurance products as a complement to our lending operations. And then we can go on to see the types of insurance products that they offer. Our primary insurance products include optional credit life insurance, accident and health insurance, involuntary unemployment insurance, and personal property insurance. Cool, so they have a bit of a diversified stream of income. So we got that down pat, and we now know what the company does and how it makes its money. And you might have forgotten, like it might have slipped your mind, so subscribe. Now next, we want to look at the company's revenue and earnings and see how they trended over time. Because we want to own a business that's growing. We don't want to own a business that's declining or staying stagnant. If we buy a business today and we continue to own it while it continues to grow and grows by a good amount, then we'd like to make some money. So first things first, we'll look at regional management's revenue and see how that's trended over time. And when we scroll down and look at the chart, you see it's a beautiful chart and it's trending upward. And then we can go down to the table so we can see the exact numbers. So we see that in 2020, they had $374 million in revenue. And way back in 2007, they only had $57 million in revenue. So you can see that the revenue has grown over this time period. Now, if this was reversed and it was 374 back here and 57 here, I would have moved on to the next company. You don't get my investment. But this represents about 15.6% growth per year, which is beautiful. And next, we can look at the company's earnings or net income over that same time period. And you see that the chart is not as pretty as the revenue. We can see a bit of a dip right here and then a large spike back here. But then we can see the actual earnings over this time period as well by going down to the table. And we see that in 2020, the earnings were 27 million. And back in 2007, the earnings were only 3 million. And then when we calculate this out, the earnings over this time period have grown by about 18% per year. Again, beautiful. Now we got that picture, so keep that in mind. We're now going to look at regional management's profit margin. Now I pulled up regional management's income statement in Yahoo Finance so we can see the company's profit margin. And when we look at the company's net income, we can see that the company actually profited $58.5 million in the trailing 12 months. And this is off of $340.7 million in revenue. So from here, we can do a quick calculation and we can see that their profit margin in the trailing 12 months was a little over 17%. And then quickly glancing at each of these years, you can see that that's pretty consistent. Now, again, because this business does cater to those customers that have lower credit, it was something else that I wanted to look at, and that is the credit losses provision. So basically, this is the line item that accounts for when they loan out money, they say that, hey, we're probably not going to get this money back because people just won't repay. So in looking at this, I saw that typically about a third of their revenue is lost to credit loss provision, which I said, okay, I can take that on the chin. Because at the end of the day, when you come down to his net income, it's still above 10% consistently every year. So we're looking at the business so far, and we're kind of getting the feel for it. We just saw their profit margin. Next, we'll look at the company's cash flow statement so we can see the company's operating cash flow, dividends paid, operating cash flow to capital expenditures, and free cash flow. It would be hard for me to pick one statement out of the three statements, but this is probably my favorite statement. So I can just see the cold, hard cash and the flow of it within the business. So we see that for the operating cash flow, they had consistent positive operating cash flows as far as we can see. And then when we expand out the financing cash flow, we can look at the dividends that they paid. And we see that they didn't start paying dividends until 2020. So, just something to keep an eye on if your goal is to receive dividends. With this company, because I feel like it's a faster grower, I'm not too heavily concerned with the dividends that they pay out because I'm sure they're retaining a lot of their earnings, retaining a lot of the money so they can actually continue to grow the business. So just take that money and reinvest it back in the business so they can grow even further. And that adds value as well. So you'll just see it in the form of the business growing, more people becoming attracted to the business and the stock, and then that driving the price up of the stock rather than, you're just getting that cash up front in dividends. But also, they have paid out dividends for, the last 2 years. And then we can close this up to see the operating cash flows to the capital expenditures. So we see that the capital expenditures for the trailing 12 months, capital expenditures amounted to $5.7 million, but they had operating cash flow of over $170 million. So this just tells me that this is not a capital intensive business. I love to see it. I love to see it. And when we take the operating cash flow, subtract out the capital expenditures, that's how we get the free cash flow of $164.6 million. So they just have a lot of free cash flow left over from their operating cash flow because they don't have a lot of capital expenditures and a lot of things a lot of plant, property, and equipment that they have to spend cash to maintain, upkeep, and buy more. Listen, a business can't have long-term success without cash. If you don't remember anything else from this video, remember that. Now for the balance sheet and return on equity. We'll look at those together. And then we can look at the company's balance sheet. And from here, we can quickly go over it. I just want to look at, I'm going to expand out the total assets and the total liabilities. And I just want to look at their net loans, so the money that they lend out and they're going to receive interest on this money versus their debt. So I see that the net loans amounted to $951.7 million, and their debt, all in all together, just quick math off the top of my head, it's around $790 million. So they'll borrow this money at a lower rate and then turn around and lend it out at a higher rate. So this isn't something that I'm incredibly concerned about. And this is just a quick check that I can do to make sure that they don't have a debt amount of $2 billion versus loans of $200 million. Because then I'm like, whoa. Hey, you're likely not going to be able to continue on with that sort of business. And this is due to the fact that they have to pay back these loans plus interest. And then we can close these out so we can look at the return on equity. Now, to get the return on equity, we have to go back over to the income statement and look at the net income. We take the net income of 58.5 million and you divide it by the total equity of 272 million, and you multiply that by 100 to get a percentage. And the return on equity is over 20%. So this is great. This is a company that's been efficient with the equity that they have in their business. And finally, we can look at the price. Now, even if everything checks off, if we look at the price and the price is astronomically high, then you likely don't want to put your money there. Don't get finessed. Don't overpay. So first, looking at the price to earnings ratio, we can see that the price of each share is now $47.03, and the earnings per share, so each share earned or had net income of $5.24, giving it a price to earnings ratio of 8.97. So this is not an incredibly high price to earnings ratio, and to me, this is an attractive price to earnings ratio. And then in order to get the price to free cash flow, we take this market cap of 499.7 million. Then we go over to the cash flow statement and we divide that 499.7 million by the free cash flow of 164.6 million. And when we calculate this out, we can see that the price to free cash flow is a little over 3 times. And to me, this is beautiful because this just lets me know that, hey, if I bought the whole company today, then it will pay me back likely in around 3 years or less, assuming that it doesn't drop off dramatically. And that's the name of the game when it comes to investing. I want to put my money down and get my money that I invested back as soon as possible. So then after that, I can break even and then continue to get the cash into the future for as long as I hold this asset. And that's all she wrote. Now, when I looked at everything and I took in all the information, I said, oh yeah, that's a good buy. But now it's your decision to make. I'm not here to tell you what to do with your money. That's your responsibility. But if you want to see an example of what I feel is an overpriced company, watch this.
So, Guy loves to own these great businesses that have very strong moats and they are blue chip, really good businesses, okay? The problem is that when you own these really great businesses, everybody knows they are great, okay? So the price is very high. Usually the price is very high. And I tell him, it's not about the great business, it's about the great investment. So a company can be really good. It doesn't mean it will be a good investment. And a company can be not so good, and it could be a great investment. So the interesting thing about the investing game is, if the game was simply about finding the best assets or the highest quality businesses, it would be a very simple game. Because we can obviously figure out what business is great and what business is not so great. That's not so hard to figure out. So I found this okay business in India, which I thought was going to become a better business. People haven't heard about it, it's kind of unknown. And I told Guy, this business, this quirky, unknown business, is going to be a great investment.